In the context of Forex trading, a moving average, MA, is a commonly used technical indicator that helps traders analyze price trends and identify potential entry and exit points. A moving average is a smooth line that represents the average price of a currency pair over a specified period of time. It helps filter out short-term price fluctuations and provides a clearer picture of the overall price trend. A moving average is calculated by adding up the closing prices of a currency pair over a specific number of periods, such as days or hours, and then dividing by the number of periods. As new data points come in, the oldest data point is dropped, and the calculation is updated. This creates a moving average that adapts to changes in price over time. There are different types of moving averages, with the two most common being the simple moving average, SMA, and the exponential moving average, EMA. The main difference between them is in how they give weight to different data points. The SMA gives equal weight to all data points in the calculation, while the EMA gives more weight to recent prices, making it more responsive to recent price changes. Moving averages are used to identify trends in the Forex market. When the price is above the moving average, it's often considered an indication of an uptrend. Conversely, when the price is below the moving average, it's often considered a sign of a downtrend. Moving averages can act as support and resistance levels. Traders often look for price bounces off moving averages as potential entry or exit points. For example, during an uptrend, the price might retrace to the moving average and then continue its upward movement, potentially providing a buying opportunity. One of the most common trading strategies involving moving averages is the moving average crossover. This strategy involves using two moving averages of different periods, example, a short-term EMA and a longer-term EMA, and looking for crossovers between them. A bullish crossover occurs when the shorter-term moving average crosses above the longer-term moving average, signaling a potential uptrend. A bearish crossover occurs when the shorter-term moving average crosses below the longer-term moving average, signaling a potential downtrend.
Are you a trader? Aren't you profitable yet? Do you need a free consultation? Go to the Forex Academy website. Select Consultant Appointment in the main menu and finally set up an appointment to talk with our experts.
We express our gratitude for your attention. Forex Academy ensures weekly Forex and crypto analysis and forecast to keep you updated. Optimize your trading decisions with our daily Forex and crypto signals. Support us by liking, commenting, and subscribing to receive our profitable signals and insightful analysis.